On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. It's been a very rough start to August for financial markets, with the US shares suffering the biggest decline in almost 2 years during the Monday trading session. We've seen a sharp bout of risk aversion hit markets. Bond yields have been lower and growth assets have sold off aggressively, with volatility measures surging. The Japanese share market has fallen 20% in just 3 days. That's the biggest slump we've seen in data going back to 1949. We've never seen a 3-day move as big as that. Meanwhile, the S&P 500 in the US is down 8.5% from its peak, which came 3 weeks ago, and the tech-heavy Nasdaq has fallen 13.1%. Interest rates are down sharply amidst the nervousness. We've seen US Treasury yields fall to their lowest level in more than a year, and the New Zealand 5-year swap rate is at levels we haven't seen since the middle of 2022. That has been good news for many investors because it's meant that bonds and fixed income have risen solidly despite the turmoil we've seen in other asset classes. Gold prices have pushed higher, oil is down as investors question where demand is headed, while Bitcoin has tanked more than 20% during the past 5 share market trading sessions. It's difficult to pinpoint the specific catalyst for this volatility, and as is often the case, rather than just being one thing, it's probably several factors. Worries about faltering US economic growth are part of it. After last week, we saw the ISM manufacturing index and then the jobs report miss expectations. That's fueled talk of recession, as well as speculation that the US Federal Reserve might have missed a trick by not cutting interest rates last week. We also saw another interest rate hike from the Bank of Japan. That actually came on the same day last week that the Fed chose to hold firm, and that seems to have had an impact too. It's seen the yen rebound more than 10% over the past month, upending the so-called carry trade, which is where investors borrow in cheap, low-cost currencies like the yen and use those funds to purchase assets elsewhere. We're seeing that unwind, and that's definitely one reason why the Japanese market has seen more volatility than most around the world. Ironically, the US earnings season has actually been quite solid for these last few weeks. However, we have seen a few high-profile misses from some of the tech heavyweights in particular. That's seen the Magnificent Seven fall 17.1% since last month, while the rest of the US market has held up a little better. Whenever markets rise very strongly, they always become a little more susceptible to bad news or changes in sentiment. And in that regard, bear in mind that Japanese shares and the US tech sector have been some of the biggest gainers over the past 18 months. Looking ahead, the volatility could continue until this nervousness subsides. The Fed may have indeed made a policy error in holding rates firm last week, especially considering the weaker labour market indicators we've seen. That might have increased the odds of a sharper economic downturn, but it doesn't guarantee that one is imminent. At the same time, we do need to acknowledge that recessions are an inevitable part of the business cycle, and investors can't hide from those. If we are headed for an extended period of volatility, here's how those times usually play out across markets. Bonds and fixed income usually perform well, especially government bonds and those from high-quality corporate issuers. The high-risk bonds don't give you the same protection. Gold often benefits as investors flock to safety, while oil and other demand-dependent commodities can suffer. When it comes to currencies, safe haven currencies like the US dollar often find support, while higher risk currencies, and that includes the New Zealand dollar, can suffer. For share market investors, recessions aren't particularly enjoyable. The five biggest US share market declines of the past 50 years all came in the wake of recessions. Those economic slowdowns can lead to higher unemployment, lower confidence, falling house prices, and a decline in consumer spending. That all feeds through into weaker economic activity, which pressures corporate earnings and can often make share prices fall. There have been four US recessions since the 1980s. There was the 1990 recession, the one associated with the dot-com bubble bursting in 2001, the GFC, obviously, between 2007 and 2009, and that very brief but quite painful COVID-19 recession of 2020. The S&P 500 in the US fell heavily in all of those recessions, and all 11 of the main market sectors declined. However, the two sectors that proved to be most resilient have been consumer staples and healthcare. On all four of those occasions, during all four of those recessions, they outperformed the broader market. That's not surprising. Companies in those sectors tend to be lower risk, more defensive, and less exposed to the ebbs and flows of the economic cycle. Consumer staples companies are in the business of necessity, and even during a recession, people tend to buy things like shampoo, toothpaste, and toilet paper. Likewise and similarly, demand for healthcare services also tends to be quite stable, not recession proof, but definitely recession resilient. It's often the last thing that people scrimp on when they are forced to tighten their belts. At the other end of the spectrum is the financial sector, which has been the worst performing sector during all four of those recessionary periods. Banks find themselves in vogue as interest rates are rising, and they can do well, but they aren't a great place to be during an economic downturn. Bad debts tend to increase, and people hunker down rather than rushing out to borrow more money. After financials, and this is quite an interesting one, the next worst performer during those four recessions has been technology. Now, the tech bulls would note that these numbers are heavily influenced by the dot-com crash 20 years ago when the tech sector was hit particularly hard. Things are different these days, with many tech companies almost utility-like. That should see them hold up a lot better during a rough patch. Businesses can't easily do without Amazon's cloud services or without the Microsoft suite of products. Then again, if you look at the COVID-19 recession, that was an oddball one too. And that period saw tech stocks perform very strongly because we're all stuck at home using online shopping and video conferencing. And in contrast to the period of the dot-com crash, that period probably flatters the numbers a little bit for the tech sector. Here in New Zealand, looking at companies on a sector basis doesn't work quite as well. Our market is much smaller, and you've got the nuances of individual stocks that can really distort things. However, I would say the same principles still apply. One would expect the large, stable, defensive businesses to hold up best in any downturn, while those tied more closely to the economy or with a greater dependence on consumer spending could suffer the most. The local share market does often prove more resilient than most other markets when volatility hits, and it's probably positioned as well as it can be right now. As of this morning, the NZX 50 had slipped a much more modest 3.1% from its recent peak, so it hasn't fallen nearly as much as some of those other higher risk, higher growth markets across the world. Also important to bear in mind that the New Zealand share market has lagged most others over the last 3 years, so valuations aren't nearly as much of an issue as they are in other parts of the world. At the same time, our economy has already been in recession over the last 18 months, so in many ways, we've taken our medicine. It's impossible to predict, at least with any accuracy, where markets will go from here. This could be the start of an extended period of volatility, or we might see a circuit breaker of some sort in the form of a positive economic release or a soothing comment from a central banker, or simply the weakness that you're seeing could attract some bargain hunters at some point soon, and you might see that caution quickly turn to optimism. I think for nervous investors, the best defense is always to hold a little more cash than usual, to add to good quality fixed income, and to ensure that your share portfolio is widely diversified with a tilt to the more stable, resilient sectors. And for newer investors, I think it's really important to note that sell offs aren't anything unusual, and in fact, they can provide some of the best opportunities for you as a long term investor. Since 1960, the US share market has endured 33 corrections of 10% or more. That equates to one every 2 years, so they come pretty frequently. 10 of those declines developed into falls of more than 20% plus, and we've also seen 9 US recessions over those 6 and a bit decades. Despite all of that, US shares have provided investors with a very healthy annual return of 10.8% per annum over the entire period. That's all for today. Hopefully, that's useful. Hopefully, that puts some of this volatility in perspective. If you do have any concerns or questions, or if you're worried, my advice would be that you get in touch with your advisor and ask for their guidance and assistance. I'm sure they would be happy to provide it during periods like this. Thanks for listening.
For more insights, visit craigsip.com.